Welcome back to the Deep Dive. Today we are digging into Kestra Medical Technologies, or KMTS. We've got their Q2 fiscal year 2026 earnings results, and it's a fascinating one.
It really is. This is a classic growth versus burn story.
Absolutely. Yeah. The whole conversation is about what you choose to focus on.
Exactly. So KMTS, they make the Assure wearable defibrillator system, and this quarter, they basically put a question to the market. Are you going to look at our incredible top-line growth and margin expansion, or are you going to get stuck on the fact that we're losing more money in the short term to achieve it?
And we're going to break down how that played out, because the initial reaction was, well, it was a bit of a head-scratcher.
So let's just start with that snapshot. For the quarter ending October 31st, it was a really conflicted picture.
It really was. You have to start with the good news, the revenue.
Right. Revenue came in at $22.6 million. That blew past Wall Street's expectations.
Yeah, they were looking for, what, 21 million?
21 on the dot. So really strong beat there. And that's 53% growth year over year. Just massive.
53%.
Yeah.
But, and this is the big but, this is where the anxiety started, the bottom line.
The EPS, yeah. The GAAP EPS was a loss of 64 cents a share.
And the consensus was looking for a loss of 57 cents. So they missed. You have this explosive growth on top, but a bigger loss than anyone was ready for.
And that's what the market saw first, right? The stock dipped because all they saw was the wider loss. It created a bit of a panic.
A very short-lived panic, though, because then people started digging in and found the stabilization factor.
The real star of the show, gross margin.
Yes.
It climbed to 50.6%. And management on the call, they specifically called that an important milestone.
Okay, let's put that in context for everyone listening. 50.6%, that is an 1,100 basis point expansion over last year.
11 full percentage points of improvement. It's huge.
It is. I mean, what does that signal for a company like this?
Well, for a medical device company, especially with the leasing model like theirs, crossing that 50% threshold, it's a critical shift. It's the point where Wall Street stops seeing you as just, an R&D project burning cash.
Right.
And starts modeling you as a future cash flow machine. It proves the unit economics were scalable.
And this wasn't a one-off. It's a trend. This was the 8th straight quarter of sequential gross margin expansion.
Exactly. It shows the business model is working. I mean, they're confident they can get to 70% plus in the next few years.
So how do they get there?
It's three things, really. First is volume leverage. They've already paid for the manufacturing setup, so every new device they lease out is just cheaper, relatively speaking. Scale, exactly. Second is getting a higher in-network mix with insurers. That helps them get paid faster and more reliably.
Okay.
And third is just getting better at the logistics, improving the cost per fit for each patient.
So the margins look great, but they are clearly spending a lot to get that growth. Let's talk about the burn, the expense side.
Yeah, the OpEx. This is where you see their commitment. Operating expenses jumped to $43.2 million this quarter.
Which led to that wider loss.
Right. An adjusted EBITDA loss of $19.7 million, which is wider than the $16.1 million loss they had last year.
And that's mostly going into sales.
Primarily commercial expansion, hiring more sales reps, more clinical specialists, and then, the costs of being a public company.
So the big question then is, can they afford it? Can they keep this up?
Yeah.
Did they secure the cash runway?
They did. And the timing was, frankly, brilliant. They ended the quarter with about $175 million in cash.
Okay, that's a decent cushion.
But here's the kicker. That number doesn't even include the capital raise they did right after the quarter closed.
That's the key move.
It is. They went out and did a primary equity offering that netted them another $148 million. It closed December 4th.
So they basically used the strong quarter and their good clinical data as a springboard to raise money.
Perfect timing. It completely de-risks the story. It gives them years of runway to keep scaling without having to worry about cash. And with that confidence, they immediately raised their full-year revenue forecast.
Right, they bumped it up to $91 million.
Yep, up from 88, which was already up from an initial 85. It's just a huge signal of momentum.
And that momentum is coming from getting their device into more hospitals, more clinics.
Commercial execution. They've expanded to about 100 active sales territories now. That's up from just 80 at the end of last year. So they are planting flags everywhere.
But it's not just about the number of territories, right? It's about how effective they are. You mentioned the payer scale.
Yes. The in-network mix. This is so critical. When they IPO'd 9 months ago, only about 70% of their business was in-network with major insurers.
Okay.
Now it's in the low 80s. That means they get paid faster, there's less paperwork, and it's a much smoother process for the doctors prescribing the device.
And that has to help with converting a prescription into an actual patient wearing the device.
Directly. Their conversion rate metric climbed to 48.8% this quarter. The goal is to get closer to their main competitor, who sits in the high 60s. Every point they close that gap is just pure profit.
Okay, so strong financials, aggressive commercial push. Let's pivot to the competitive mode, the clinical data. We have to talk about the ACPS study.
Yeah, this is the other major accelerant. ACPS is a massive competitive wedge for them. It's the largest real-world study ever done for these devices, over 21,000 patients.
And it basically proved that their Assure system is just better.
Better in ways that really matter to patients and doctors. So number one, wear time. Patients in the study wore it for 23.1 hours a day.
Wow. That's basically all the time.
I mean, you're only taking it off to shower. That kind of adherence is almost unheard of for a wearable device. It just shows it's comfortable and not a burden.
Low false alarms probably help with that.
Absolutely. 94% of patients were free from false alarms. That's a huge quality of life metric.
But the really interesting takeaway from the study, the one that could actually grow the whole market, was about the risk level of these patients.
This is the key insight. The study confirmed that this patient population is at a much higher risk than many doctors even realized.
Lower the numbers. Sure, they have to say that.
But this kind of evidence from ACEPS is exactly what guideline committees look for. If they broaden the criteria for who should get a WCD, the market could unlock overnight.
So looking ahead, they also talked about a steady stream of innovation. What do they mean by that?
They're thinking beyond just this one device. They see 3 platforms. The WCD itself, a broader wearable platform, and a digital platform.
So they see themselves as more than just a defibrillator company.
For sure. That digital platform is key. They're collecting enormous amounts of real-world data from people wearing this thing 23 hours a day. The WCD is almost like a Trojan horse for data collection.
Right. High-fidelity data that could be used for all sorts of other cardiovascular diagnostics. That's where the long-term value could really be.
They're positioning themselves as a comprehensive heart monitoring company that also happens to provide therapy.
All right. This is a perfect spot to shift to our final segment. This is where we take this whole story and pitch an outrageous but plausible idea. And a very important reminder for everyone. This is absolutely not financial advice.
Not in any way. This is just a thought experiment based on the narrative coming out of the call.
So you set the stage. What's the trade?
Okay, so the stage is set. The market has shown it's siding with growth over burn, and the company just took its biggest risk, the cash position, off the table with that $148 million raise.
They have a full tank of gas and a clear road ahead.
Exactly. Now, most Wall Street price targets are sitting somewhere around $30 a share. We think that might be underestimating the potential here.
The aggressive thesis is what?
The aggressive thesis is that the superior clinical data, the 50% plus growth, and that 50.6% gross margin milestone justify looking much further out. The trade idea here would be something like a long KMTS call spread, betting that the stock could hit, say, $35 within the next fiscal year.
So you're betting that the story fully shifts from growth versus burn to growth despite the burn.
Precisely. You're betting that the capital they just raised allows them to spend so aggressively on commercial expansion that they completely overwhelm the competition, and the market rewards them for it, especially if there's even a whisper of a guideline change.
An interesting idea. Okay, let's wrap it up. What's the core thesis on KMTS today?
It's pretty simple, really. They have a superior product in a market that's still underpenetrated. They are expanding their footprint to 100 territories. Their economics are clearly and consistently improving. And now they've got all the cash they need to fund that growth. The momentum is undeniable.
So let's leave our listeners with something to think about. We talked about that massive ACPS study, 21,000 patients. That's an incredible data set. Management even said they'd use it to look at unmet needs in other patient conditions.
Yeah, that was maybe the most interesting forward-looking comment on the whole call.
So the final question for you to mull over is this. What other secrets are hiding in that data? Given all the detailed heart rhythm and activity data they've collected, what other conditions could KMTS pivot to? What new business could they launch that has nothing to do with defibrillators? all based on the insights from that data set.
That data could be their most valuable asset by far.
Something to think about. Thanks for joining us on the Deep Dive.